The Bank of Canada cut rates this week, and at the press conference, the governor, Tiff Macklem, noted that one of the key reasons for the rate cut was that tariffs are restraining household spending intentions. That's right. He said out loud that the Bank of Canada is ultimately trying to stimulate Canada's housing market. Plus, the average wealth of Canadian homeowners just saw one of its largest increase in decades. This episode is going to piss some people off. Let's dive in. Okay, Bank of Canada, right off the top. They cut rates for the 7th time in a row this week, lowering the overnight rate to what is now 2.75%. The last time rates were in this range was August of 2022. The key reasons for the cut were shared by the governor, Tiff Macklem, stating verbatim, "In recent months, the pervasive uncertainty created by continuously changing U.S. tariff threats has shaken business and consumer confidence. This is restraining household spending intentions and businesses' plans to hire and invest." All completely true. He basically said the cut is intended to help housing spending again, and of course, to stimulate businesses to be able to grow and hire more people, all incredibly important to our economy and overall GDP. The housing market is clearly rigged in Canada, and the powers that control it are becoming more liberal in their openness to speak frankly about what they're trying to do. Right? We all remember last year when Trudeau said that housing can't lose its value. And here we are with the governor of the Bank of Canada flat out saying he needs to stimulate housing again. Love it or absolutely freaking hate it. That's the game in Canada. So play accordingly. Now, do you know what the Bank of Canada's actual mandate is? Well, it's right on the homepage, right at the top of their homepage. It says, "We work to preserve the value of money by keeping inflation low and stable." Maybe it's time to change that to "We work to preserve the value of housing by keeping inflation low and stable." Looking forward, what's going to happen now with rates? Well, markets are still pricing in the likelihood of a 25 bip cut at the April meeting, with one more cut of 25 basis points happening by fall. That would round out 2025 with an overnight rate at 2.25%. So what does the new today 2.75 overnight rate mean for the 25 odd percent of all mortgages that are renewing this year, right? They're starting almost right now in the sense that this is 5 years since those rock bottom pandemic interest rate mortgages. Well, we had our mortgage specialist run some numbers, and this is exactly what it looks like if you're renewing today or in the very near future. If you took out an $800,000 mortgage 5 years ago in 2020, let's say you're buying $1 million house, $800K mortgage, you had a 30-year amortization on that, and let's say you got a nice juicy rate of 1.8% fixed. Your payment would have been $2,875 up to and including this month. Now, if you're renewing in March, you're renewing in April, you're maybe renewing in May, we'll see what they do with rates next month, but you're renewing now. Today, the lowest possible fixed rate is somewhere around 4.39. Okay, you'd have 25 years remaining on your amortization, and your new balance would have been $695,000. Okay, you've paid off $105,000 of your principal over the last 5 years. You're now sitting at the balance, $695K. A 5-year fixed mortgage today would have new payments of $3,802. Okay, so we're $927 more per month on this renewal, So ultimately, payments are still 32% higher, even after 225 basis points of cuts. So not a small number. And as people renew, they are still ultimately going to feel that payment shock.
I think too, if you were on that mortgage product that was a variable rate but static payment, you may end up in this scenario, although you're renewing your mortgage for roughly what you took it out for 5 years ago, making it potentially even more painful when you renew, because you're now, instead of renewing at $694,000 and paying that $100,000 down, you paid $100,000 in interest and you're renewing $800,000 at new rates, which would push those payments even higher. So it really also depends on your mortgage product. And that's, it's largely going to contribute to inflation too, because we're talking a lot about interest here. And let's sort of maybe touch a little bit more on inflation, because while projected lower rates sound enticing to mortgage renewals, and potential home buyers, it's going to be for a short period of time. And it really depends on how we continue progressing with the tariff situation here, because there are dark inflation forming clouds ahead of us here. And it's giving us cause to look sharply at the rates. The early indicators of rising inflation are now flashing yellow. The raw material price index jumped 3.7% in January and is up 11% in the last year, the highest since September of 2022. These higher prices make their way, obviously, to the end user, the consumer. And what's more is the industrial product price index is up 6% year over year. And given its history of predicting core inflation, roughly 10 months down the road as a leading indicator, you can expect upward pressure on inflation to come from this metric. So pay attention to this index. Lastly, 20% of businesses are expecting to raise their prices by 6% or more this year, also contributing to future rise in inflation. But think, if prices are on average rising by 6%, and the bank is telling you that their inflation rate is around 2%, I'll let you decide what the real inflation number is. We may very well be increasing in an increasing inflation environment by Q4 of this year. Now, a lot can happen between now and then, but if you've been riding this variable rate down for the last 8 months, this is a good time to be considering locking that rate and riding through what we're likely going to see as inflation in the near future.
Now, one positive element that we want to discuss this week is the rise in wages. Now, we definitely have a soft labor market environment right now, but the average first year adjustment on wages is actually closing in on a 4% increase. And that's more than double the rate we have seen from 2010 all the way up to 2022. And in fact, the most recent payroll data shows the average weekly earnings are actually up 6% year over year. That's the highest reading this metric has ever seen since they started collecting that data back in 2001. So even with inflation, at or below 2% for the last 6 months in a row, wage increases are averaging triple the rate of current inflation. Though, I think we can all agree there's a lot of catching up to do in that department.
Yeah, you nailed it there, Dan. Let's go wages, right? But at the end of the day, much like we just talked about, businesses are raising their prices by 6%, and wages also went up by 6%. It's just a function of staying in the economy. Looking here now at employment, the unemployment rate in Canada remains steady at 6.6% in February, though it has been on a steady increase since the cycle bottom of 4.8% in 2022, or in July of 2022. Big picture though, 10 years ago, February 2015, the unemployment rate was higher, then at 6.9%. So that's something to consider for future unemployment numbers. The quarterly change in work permit holders too in Canada is dropping dramatically. This is very interesting because it peaked in Q4 of 2023 at nearly 200,000. And we've seen a steady decline now down to just 40,000, potentially freeing up jobs for residents, but in all likelihood, is a large portion of those jobs that no longer exist as a result of the economy that we find ourselves in. And I'm sure you can understand where this shift is heading.
Where we don't know what is heading, where is pretty much the tariffs. I'm not even going to timestamp this one because it's just absolute chaos right now. And it doesn't really matter if they're in or not because it seems to change almost hourly. But what lasting effects are going to have on this ultimately, I guess, tariff chaos, we'll call it, is unknown. But what has had an immediate effect, what is in place right now, is the effect on consumer sentiment. The index of consumer confidence has dropped to levels below the global financial crisis and are just above the pandemic shutdown level. So that ultimately means the current economic climate in the eyes of the average consumer is worse than the global financial crisis, which had very realized impacts, and are almost as bad as the pandemic shutdowns when people were literally dying by the thousands on a daily basis. That's how consumers feel about our world right now from the point of consumption. The outcome of this is typically, to hold on to your cash, right? Who's going to go spend stuff when you think the world is absolutely falling apart? The percentage of households that perceive a deterioration in their current financial situation, well, that's getting worse, right? It rose 2.7% to basically 34% today, right? More than 1 in 3 Canadians feel that their current financial situation is deteriorating. And simultaneously, the proportion of consumers thinking it's a bad time to make a major purchase, that's up to 63%. So you've got 2/3 of all Canadians who are not even considering making a major purchase right now. And obviously that includes houses, right? How you don't really think about buying a nice house or a car or boat or what have you, if you again think that the world is falling apart and the economy is going down the drain. Business confidence indexes are dropping too, and understandably so. The business investment overall looks to be very weak until the tariff issues are resolved, though I imagine businesses will be, trepidatious at best moving forward, right? Because if it's not tariffs, good chance it could be something else. I suspect GDP is going to be dropping notably over the next couple of quarters, at least here, based on sort of the economic factors and the early indicators, right, from the consumers and from the businesses. If they're not growing, they're not spending, they're not hiring, pretty hard to see GDP going anywhere but down.
Interesting too, Dan, when you mentioned that, it just shows you the state of our economy when businesses are expecting to raise prices by 6%. And yet the current financial situation for the average Canadian is deteriorating by 1 in 3. And the odd time to make a major decision, or people thinking it's a bad time, going up to 63%. I mean, we're heading towards what feels like a brick wall pretty quick. It's all the indicators are pointing not a very great looking future in that respect. Let's talk BC. Let's talk sales volume here in BC here. So this is definitely being seen here in BC as well. CREA has reported that 4,947 home sales were recorded in February of 2025, and that's down nearly 10% year over year, with an average home price in BC now down 2.5%. The total sales dollar volume was $4.8 billion, and that's nearly 12%. That's nearly a 12% decrease from the same time last year. BC MLS unit sales were 28% lower than the 10-year February average. And this all makes sense. It all is trending with what's going on in the economy. In year to date, BC residential sales dollar volumes are down 4.5%.
Yep. Really speaking to what is a nothing burger spring market that we are literally in the midst of, and more on that next week. But let's talk about one metric that we like to discuss every month, and that's the arrears data, right? People who have not paid their mortgage in 3 months or more. That metric is rising, and it is at 0.22% as of December of last year. And that it was an increase of 0.01%. And I am talking nationally, of course, here. These rates are now, the arrears rate is at a 4-year high, emulating the environment that we saw last in April of 2021, though we are still 0.03% below those good old pre-pandemic levels, right? Nothing's been normal since, so I'd like to reference that to kind of give people perspective as to where it sits comparatively. So after 4 months at 0.17%, BC rose a bit to 0.18%. Still below that national average, of course. Quebec is the same, and is the second lowest in the country is Ontario, which is now at 0.19%. BC and Quebec are the lowest in the country. The province with the highest arrears rate is Saskatchewan. It's at 0.6%. But what's very interesting here is that Saskatchewan, of all the provinces that this metric takes into account, actually has the highest affordability index for housing in the country, but the worst arrears rate. So homes are more affordable in Saskatchewan based on purchase price compared to average income, and yet somehow people are the most behind on their mortgage payments. Whereas you look to the opposite, where you've got Ontario and BC have the absolute worst affordability index, rather, but the lowest arrears rate. prices are the highest, wages don't compare even close, but everyone's paying their mortgage. It's a super unique dynamic that I kind of looked up today. So the more unaffordable the housing market, the higher the likelihood of a better arrears mortgage rate. It's really bizarre at best. I don't know. I'm kind of losing faith in how important this arrears rate is. 2 weeks ago, if you remember, if you watched that episode, I demonstrated how even at all-time high peak arrears rate, prices were still going up. So you've got high arrears prices going up. You've got lower arrears prices going up. I don't know. Maybe I should just stop reporting on this metric as a whole. Let me know your thoughts. Like, do you want to continue to hear about the arrears rate moving forward? Please, I'd love to hear your thoughts. Comment below.
I wonder, Dan, if people in Saskatchewan have the highest arrears rate because all their money is being sucked out of the carbon tax to heat their homes in the wintertime. It's hard to know. But there's one thing I don't really like, and that's taxes. And we're going to talk more property transfer tax here, because when the province runs a $10 billion deficit, they are running out of cash. And with GDP dropping, what is left? You have to tax the people some more. So BC is looking to add even more taxes to housing. And we all know how heavily BC citizens, especially homeowners, are taxed here. There's income tax, sales tax, property tax, vacancy tax, anti-flipping tax, spec tax, GST. There's all kinds of taxes here. It's insane how much taxes are here. But now there's talk of even more potential tax measures making its way into the real estate market. The expansion of the property transfer tax to include beneficial transfers, as if property transfer tax wasn't already enough of an inhibitor to transactions taking place in BC. The government is drunk off of these profits, and they're now going to get more of them from you, or at least they're going to try. Currently, property transfer tax applies when legal title to a property is transferred, but it does not apply when only the beneficial interest changes hands, such as in cases where real estate is owned through a corp and shares are sold instead of the property itself. If this tax expansion is implemented, it'll have major implications for buyers and sellers and investors across BC, and specifically into the commercial and industrial markets that BC has. It's just another way of the government making sure that they're collecting. There's a strong possibility that this change is coming soon. So if that's important, I'd start planning it now. The way you could typically get around buying or paying for property transfer tax is if your corporation bought the shares of a controlling corporation of that property. It would reduce the taxes. I mean, you still pay taxes on the sale, but why not add to more, I guess? I don't know, Dan. It's trying to get ahead in this province is seemingly impossible, or getting harder and harder anyways.
Mm-hmm. Yeah. In front of the cameras, the politicians say that they're doing everything they can to make housing more affordable. And then they go back and sign an initiative to charge more tax. It's just, we see it time and time again. And here's another glaring and very current example of that. It's frustrating at best. Now, I do want to make a comment here, a quick segment on some of the rules of cooperation, because they've changed slightly, and it's an interesting shift. And it's all about when you write offers as a buyer to buy a home in British Columbia. So if you're considering buying a home in BC this year, it could be really important. If you remember back in 2021, 2022, the real estate market was red hot, like the hottest it's ever been here. And many homeowners were advised by their realtors or themselves to create an environment of a bidding war. And they would do this by saying, okay, we're going to list the property on Monday and we're going to show people the home for a whole week. And then on the following Monday, everybody gets to submit and compete against each other and bid up one another. And hopefully we get a really nice price for our home. But every so often, a bully offer would be presented. And that simply means they didn't wait until the offer deadline and they said, hey, we really want this home. Here's our offer. Will you look at it anyway? And sometimes that offer was so amazing, they just flat out took it, leaving all sorts of potential buyers in the lurch who maybe didn't even get a chance to see that home. That could have been maybe their dream home, right? If somebody was able to act quick, they would get in on the Monday it was listed, love the home, write the offer that night, probably have it accepted one day on market. It happens all the time. So BC FSA decided in that environment that it was unfair to buyers and implemented a rule whereby if a homeowner said they were going to hold offers, they absolutely had to hold offers until the date that they had signed off on, and no bully offers could be accepted. Doesn't matter if it was twice the price of the home, you cannot accept that bully offer. It was irrevocable. So ultimately, this created a bit more of a fair market. And even though, you're still maybe competing against 10 or 20 other buyers, at least you had the chance to get into the home, maybe perform that pre-inspection, run it by your lender, get that quote pre-approval in place for that specific unit, and so on. Now, fast forward to today, and we're not in a red hot seller's market by any stretch, right? If we look at the overall marketplace, we're in what is ultimately a balanced market. And in a balanced market, very few sellers hold offers, right? The odd one will, they'll list ridiculously low. They'll hold offers, they'll get some. Quite often that fails and they don't even get the number they want. And the next day you see it listed at a much higher price, kind of more in line with their expectations. Regardless, BCFSA has reversed that rule and are eliminating the irrevocable aspect of the offer presentation rules, meaning that bully offers can be accepted again. So I don't know. Is that more fair in this environment? I guess they're trying to tip the scales back in favor of the sellers because buyers have too much power now. Is what it is, up to you to decide if you like it or not. But that is something to be aware of. So if you see a home you like, and if they are holding offers as of March 17th, as of Monday, as of St. Patrick's Day, you can present bully offers once again. So act accordingly.
Yeah, I don't know how I feel about that. Interesting. I think overall, I would just like everybody to stop touching the dials for a bit. Just focus on bringing some supply to the market. Let's just leave it there. With that being said, I wanted to touch on some of the wealth divide that's taking place in Canada here, because it's quite an interesting stat to look at. And while economic uncertainty looms over many Canadian households right now, the latest stats in Canada have revealed that household net worth actually surged in Q4 of 2024, continuing a year-long trend of rising wealth. This is interesting because I think there is a portion of the economy that this affects, and there's a portion that it doesn't affect. This growth is largely attributed to higher interest rates suppressing debt levels while asset values climbed, leading to one of the strongest quarters we've seen in recent years. Household net worth in Canada rose by 1.4%. That's about $240 billion in Q4, bringing it to a total and an impressive $17.5 trillion. For the full year, wealth climbed by 7.3%, or $1.2 trillion. Even after adjusting for per capita inflation, gains remained substantial. While the pace of growth slowed slightly compared to previous quarters, it's still running above the 10-year average. Despite these impressive numbers, wealth inequality is absolutely widening. The top 20% of households held 68% of financial assets in Q3 in 2024, a share that has continued to grow. As interest rates begin to ease, financial assets are expected to continue their rise in value, with the wealthiest Canadians capturing most of it. Falling interest rates are often framed as good news for the average household, but in reality, they disproportionately benefit asset holders, further driving this inequality. This means that while some Canadians get relief, others don't. They see significant financial gains and influence everything from housing affordability to investment trends. And one of the other things, Dan, just comparatively speaking, because this is also very relevant down south as well, reading a very interesting book, and the stat just out of last year is that 92% of the wealth in the United States is held by 1% of the population, which is a staggering number. Yeah, and just to illuminate that, yeah, it's huge. And when you deal with wealth, specifically in an inflationary environment, cash is trash. And for people who do not have assets, whether that be stocks or whether that be real estate or some form of asset that's tied to inflation, it is so hard to keep up because the rules of the game keep changing.
So own nothing and be happy, or I don't know, own assets and be happy. We're in a fortuitous position. You are free to choose. I know I've made my choice in which path I'm on.
Yeah.
Thank you, as always, for tuning in and listening. Ryan has something more to say. Please get it in there.
All I was going to say is you more or less covered it. It's just that you really need to own an asset in this environment. The wealthiest part of our economy, the wealthiest people in our economy are heavily invested in assets. And if you are looking to buy assets, it is a very, very good idea to get on that train when we start to see inflation in the back half of this year rear its ugly head.
There you have it. Wise words, and certainly what I live by. So thank you as always for tuning in and watching. If you like this episode, we'd love it if you shared it with somebody, somebody that you think would get value out of it too. Have a wonderful weekend, and we will see you here next week. Bye.